Hello, everyone. Welcome to our special edition of Investonomics, our thought leadership platform, a show in which market experts, industry leaders, and business icons share their thoughts and experiences. In last couple of months, you would have heard Mr. Ramdev Agrawal, Prashant Jain, Indra Nui, and Samir Arora. Continuing the trend of empowering and enriching retail customers, today we have with us Mr. Prashant Khemka. Prashant is not a new face to the market. He has been in the market for last over 25 years. He possesses a degree in mechanical engineering and he did his management subsequent to that. After doing his management, he joined State Street Global Advisors as assistant portfolio manager in Boston. Prashant has also worked as chief investment officer and lead portfolio manager at Goldman Sachs Asset Management Company. In 2017, Prashant founded a company, White Oak Asset Management. Today, in a short period of time, White Oak entire group manages over $5 billion of asset. Prashant is known for his stock picking ability. He is astute investors, advisors, and form an opinion in the market from time to time. On behalf of ICICIdirect and all our viewers, I would want to extend a warm welcome to Prashant. Welcome, Prashant.
Thank you, Vishal, and want to thank ICICIdirect for having me here for the program today.
Yeah, it's our pleasure to have you here today. And let me come straight to the point, Prashant. I mean, the timing cannot be appropriate than this. Last 2 years have been phenomenal. We have seen the fastest fall in Nifty of about 7,000 points, March 2020. And thereafter, the fastest rise of about 10,000 points in Nifty. I mean, the two ends of the market, and both happened in a short period of about 2 years. When we look at last 3 months, I mean, market had its own worries. Two things which are lingering on and which have decided the last 3 months market trend. One is the Russia-Ukraine war, and second is a Fed rate hike. In your opinion, which is more important variable for the Indian markets? Over to you, Prashant.
Certainly. So thank you, Vishal. So I think these are both global developments. And what needs to be considered is the tail risk, where it is higher. I would say between these two, what is more of an unknown is the war, the geopolitical situation in Europe between Russia and Ukraine, which is right now limited to Russia and Ukraine. That has a greater uncertainty associated with it, because Fed raising rates is not the first time that the world is experiencing that. You can argue the war is also not the first time, but the way the war progresses, which direction it may take, is a lot more uncertain, and in extreme situations can have very far-reaching implications for the very long term as well. So there, the uncertainty being higher, the tail risk being higher, I would say at this point in time, for markets globally, not just in India, for markets globally, the Ukraine-Russia war is a more important variable that is driving in the near term.
So, Prashant, I have been in the market for last 25 years. I mean, since 94. And all this while, I mean, one thing was very clear, as and when there's any geopolitical issue, some solution emerges, right? And I mean, I think almost in last 27, 28 years, I have seen some 4 to 5, very, very grave situations. But finally, market came out of that. Do you see this time the situation is different?
No, I think the situation is likely to be the same. And most likely outcome is there would be some resolution. Either one side would prevail, either Ukraine would be able to defend or might not be able to defend, or there can be a ceasefire at some point in time. However, there is a very small, no matter how improbable or how low a probability you want to assign, there is some small, tiny probability that it gets out of hand and spreads beyond, Ukraine. So that risk you cannot completely ignore. Besides that, the three outcomes that I talked about, which side prevails or ceasefire, might have different longer term repercussions in terms of sanctions and the magnitude and scope of sanctions and the length and the effectiveness or seriousness with which they are implemented might vary depending on the outcome of the situation. If, let's say, Russia were to prevail and remain an aggressor and forcefully were to annex, then the sanctions might be ratcheted up higher and might remain there for a much longer time period, in which case there would be supply chain disruption for longer. It's more than supply chain disruption, it's a supply shock, and that may remain for longer, and that could mean inflation for longer. On the other hand, hopefully, if there is a ceasefire of some sort achieved, then the sanctions might be substantially diluted, and that might be one of the aspects or elements of the ceasefire. And if that were to be the case, then the supply shock that is currently being faced and feared to sustain, that supply shock may no longer be there, relevant from the medium to long term perspective or beyond a few months. And so the consequent repercussions on inflation and commodity prices might dissipate very quickly if there is an amicable ceasefire that is finally achieved. So depending on the outcome, we may have, or depending on how the resolution to this situation takes place, we may have a very minimal lasting impact or to some degree higher impact in the medium term. But yes, in the very long term, these things don't have much of an impact on the rest of the world and hence on the markets.
Sure. So, I mean, as I hear you, at least for short term and medium term, some damage has already happened. I mean, that's how, the issue and the magnitude of this issue definitely has some, tail end issues, which, the economies will have to face. So
market being a probabilistic mechanism, market is constantly evaluating the probabilities and reflecting that in the day-to-day movements. Same is true for the commodity market, same is true for the equity markets and other markets as well. So when there are talks about some kind of, when there are stories about some kind of talks being taking place between Ukraine and Russia, which seem to be moving in the positive direction, then the market builds a positive expectation. But then if there is a reversal in that, and there is heavy bombardment or something, then the market again reassesses those probabilities. So those are ongoing that market would continue to assess.
Definitely. And we often hear that one thing which market doesn't like is uncertainty.
Absolutely.
I think that market completely hates. So buying at higher level is all right in certain times, but as and when there's uncertainty, market will have its own course. Yes. And it's very, very quick to decide. Very you touched on a very important subject again in your address, which is commodities. So, and one of the commodity which is deeply impacted by this dispute is oil. So, where do you see oil prices, stabilizing? And at those levels, what do you see the impact on Indian economy and Indian markets?
Certainly. So it's again similar where we see oil prices stabilizing is similarly difficult or impossible to say. I shouldn't say difficult, but impossible to say as the question saying where would equity markets be stabilizing, right? Nobody has a clue. People have zero clue, regardless of what they might like to believe or say about these macro macro, outcomes on this macro front. What we can only gauge is, what is the impact of a certain amount of oil price increase on estimated impact on Indian economy or Indian current account deficit and or so on and so, or inflation or so on and so forth. And reassess, keep adjusting that back, because oil prices were 130 just I think within the last couple of weeks. They broke or touched 130. They're 102 the last I saw earlier today. It's extremely volatile. And what would be the average price realized over the next few months? And all the commodities are in deep backwardation. So nobody, the market at least, is not expecting these prices to sustain over the long time. In the near term, they are elevated, no doubt. What uh, and again, we don't spend too much time, Vishal, as you know, worrying about these macro factors, because there's no way of making money from worrying about these macro factors. But from what I have seen, experts say every $10 of oil price has approximately 40 basis points of impact on inflation and on current account deficit, as well as on GDP. It is in that range. Again, it differs from what level to what level we are talking about, and a whole host of other factors, whether the government absorbs the impact, or whether it's passed on through the gas pump prices, and all those various factors historically have been addressed in different ways. But that's roughly the magnitude of impact. I don't think that uh, we have seen in 2008 $150 oil prices as well. 2007, remember 2003 to 2007, very rapidly rising oil prices, but the growth environment was robust enough. So one has to see oil price as one variable. And yes, higher oil price is not positive for India, lower oil price is positive for India, but one should not, the risk is that one rests or gets prone to rest their entire investment thesis. I've seen oftentimes investors do that on one macro variable, which is not advisable. But yes, higher oil price at $100 is on the margin negative for all the macro variables in India.
So still, I mean, do you see a silver lining if we stay above $100, at least for the short to medium term?
I'd just like to remind you, 2 years ago, just about 2 years ago, March 23rd, the market made a major bottom, 23rd, right? And if we were to go a little more than 2 years ago, in January 2020, if we were discussing, the debate would have been whether the GDP can grow at 5%, because GDP was a bit slow. Can it get to 6%, or will we be stuck at 5, or can we slow down further to 4? People were debating, and if GDP were to not pick up, how can the market perform? Would the corporate earnings accelerate, and all those questions? If we were told that the GDP growth was going to be minus 7.5%, because the pandemic is going to strike, and there'll be so many lockdowns, and obviously infections, deaths, biggest migrant crisis India has seen, first wave, second wave, third wave, so on and so forth. You would think the market would do horribly in such situation, right? But despite a minus 7.5% GDP growth rate, which when you think of delta, if the expectation was 5 to 6%, and you do minus 7.5, that's about 12 to 13% delta in GDP growth. And still, for the calendar year, the market delivered about 35% returns. Right? So here we are worrying about a minor 50 to 100 basis points move around and trying to understand what the implication for the market could be. I think if you look at the COVID, we would all stop worrying about these small macro variables moving in one direction or another. If a minus 12.5% move in GDP, despite that, if the market could deliver plus 35% return, one of the best returns in the year of worst economic growth, then one must pause and think, what relevance does this metric have? The current year's GDP growth, does it have any relevance for the returns from the market?
Right, right. I agree with you. I mean, Prashant, that this is one of the factor among many other factors which are having impact on market, and oil alone cannot decide the course of the market. Uh, you touched upon another important aspect, which is inflation, right? And both rate hike as well as oil prices, finally, I mean, they are going to have impact on inflation. So how comforting and discomforting is the current inflationary pressure? And how do you see it impacting the market in short to long term period?
Certainly. No, you're very right. What though I would say about inflation is from our in our view, what is most important when it comes to inflation is long-term inflation expectations.
Mm-hmm.
And not as much the near term, because most people focus on what is reported as inflation for last 3 months, 6 months, and what is projected for the next 3 months, 6 months, 12 months. From an equity market perspective, equity markets, as we always have said, and we all know, is a discounting mechanism. It's the value of any company is present value of future cash flows in perpetuity, and hence the value of the market is aggregate value of all the companies in the market. The this year's cash flows or next year's cash flows or the next 3 years cash flow are barely 1% of the value of the market. Next 3 years cash flows would be less than 2% of the value of the market. So
Mm-hmm.
because of near-term inflationary pressure, there is softness in near-term demand, volume demand, and all that. Even if the corporate cash flows get cut down by 20%, then 2% of 20% of 2% is less than half a percent,
Absolutely.
or even more if that gets cut down. Markets are not foolish to, re revalue the overall equity valuations by 20% just because near-term cash flows have gone down by 20%, because it's the present value of long-term cash flows. So what matters most is the long-term inflation expectations,
Mm-hmm.
and that can be best assessed by what's the move in the long-term yields, bond yields. So just near-term Fed hiking near-term rates does not necessarily mean long-term yields would go higher as well. And it's not just the yields, it's a combination of yields and growth. If the yields go higher, but if the growth is also substantially higher or commensurately higher, then higher yields may not be detrimental to the markets. In fact, markets might rally in the face of rising yields, as has happened in the past, including 2003 to 2007. In fact, just reading yesterday some analysis that over the last eight instances of Fed rate hikes, every one of those 8 instances, the market has been higher, has given positive return over the next 12 months. I'm talking about the S&P US here, because we're
That's
talking about Fed rate hike. Every single one of those 8, first when the Fed starts hiking rates for the first time, right? Consequent 12 months have delivered positive returns. So I think a lot of fear and hysteria is, created in media and amongst the investor community related to Fed rate hikes. But past empirical evidence is is not supportive of that. If anything, is contradicts that hysteria. So
and
inflation, I would say long-term inflation expectations remain subdued, as can be seen from the long-term bond yields. And Fed rate hikes is not what would impact equity prices beyond a few days or weeks. It is the long-term yields that one needs to look at, and even that has to be just in context of what the growth expectations are.
yeah, and even in the US markets, I mean, the opinion makers have started making statements like this kind of inflationary scenario cannot exist for more than 12 months or 15 months, and thereafter it is likely to taper down. So, I mean, I agree with you that finally the long-term trend would, have an impact on the market rather than, couple of quarters here and there.
Because remember, this inflationary pressures only started post COVID, right? And
That's right.
the reason there was no inflationary pressure earlier, and the reason is because there's a big supply chain shock. If mines are closed for weeks or months, let's take coal mine is closed for many weeks.
Mhm.
We continue to work from home, and by and large, the energy consumption did not go down as much as the production of coal, let's say, so thermal energy, thermal electricity, if we talk about. So, as a consequence, what happened earlier before COVID, everything was moving smoothly. Coal was being produced, shipped to the power stations, and power stations were burning it with some 3 months inventory, let's say, and were producing electricity which gets supplied to our homes. And the cycle was continuing in a very smooth fashion, almost like a just-in-time fashion. Everything's has become right just in time over the years. Now, if in the chain coal production is stopped for a few weeks or months, then consumption of electricity is continuing. So what's happening is power plants are scaling down or eating into their inventory. And
Mhm.
at many places, inventory was completely run out or close to completely run out. So then the cost of coal started shooting up in the near term market because production you can't ramp up in beyond what is a certain capacity, daily production run rate. So now the thermal power plants not only want to consume the coal that is required on a daily basis, but they have to also rebuild their inventory to whatever is a normal inventory. And because the supply chain uncertainties, they're not only rebuilding it to normal levels, they're taking it to a multiple of what is normal level, right?
That's right. That's right.
This is a supply chain shock. You've heard about stories about how containers have gone up in pricing by 5 to 10x, and in some
Absolutely.
cases even more. And even after paying the prices, you can't get a container.
Yeah.
All
Yeah.
this supply chain shock is what's caused inflation. Hard to imagine that this is permanent in nature, but difficult to assess how long it might continue. Maybe a few months, maybe more than a year. But certainly it does not seem that there is structurally some change. And that is why possibly the long term yields, which reflect more the longer term inflation expectations, have not moved up as much.
Sure, sure, Prashant. I mean, let me come to another burning issue and much talked today, that is depreciating rupee. So, do you see a fall in rupee value helping the exports? And in the current scenario, is it advisable to bet on few of these export-oriented stocks?
So certainly, see if there is a fall in rupee, if there were to be any fall in rupee, is going to be on the margin benefiting the exporters, at least in the near term, because the costs, if their costs are, assuming the costs are domestic, they're
Yeah.
not importing and then exporting the same
Mhm.
thing. But if the costs are domestic in the near term, it makes it a more the exports becomes more remunerative. So it would benefit in the near term. Hard to again say whether they have long term sustainable. Is there sustainability to that differential? Because inflation, if it were to pick up in India, then any currency decline can be offset by the increasing cost over time of production or input cost. But net, yes, it is a positive. All else equal, it is a positive for exporters if the rupee were to be under pressure.
Yeah. Your views, Prashant, on rupee, where do you see it getting stabilizing?
Again, it is impossible to say in the near term, but from in the long term perspective, our team factors in the inflation differential as rupee depreciation. So if you look at over the last 10, 20, 30 years, the
Mhm.
inflation differential between India and US is about 3 to 4% or somewhere in that range. India has been about mid single digit, 5 to 6%, and US has been more like 1 to 2%. So we assume those to continue, that kind of trend to continue over time, about a 3.5% differential to continue. So rupee depreciation of 3.5% over time, annualized, is reasonable to expect. It won't come in a straight line. Some years it may be 10, 20% depreciation. Other years might be flat or even somewhat stronger rupee. But base case, we assume 3.5% depreciation.
Three and a
Remember
half.
this year, 3.5%. Remember this year and last year, while rupee has depreciated against the dollar, It
Mhm.
hasn't necessarily depreciated against other currencies, because other currencies have also depreciated against dollar.
That's
So,
right.
so the export benefit is not like 100% export benefit. It's more dollar exports benefit more. Because see, if other countries also, if India is competing with Brazil, let's say, and for a certain export, and in both places currency depreciates by the same amount and inflation remains the same, then the relative benefit may not be there. So the benefit, the size of the benefit, and the sustainability of the benefit to exporters might vary from sector to sector, depending on what's the competitive situation to those sectors.
Yeah. So dollar export, I mean, that appears to be a good bet in comparison to the other currencies.
Yeah, I would say US export, because of the dollar, because Brazil and India might be denominating the services in dollars,
Yeah. Yeah.
or other Turkey and others might be denominating dollars too, but to US. And again, it depends on the competitive. Who is the Indian player competing with?
Mm-hmm.
Uh, and what is the currency dynamic in that country compared to input cost dynamic in that country? Those dynamics nuances do come in picture, but on the whole, it is safe assumption that at least in the near term, there is a certain benefit to exporters uh, from a falling rupee.
I got it, Prashant. So, I mean, moving from macros, let me come to again one of the investment ideas and often talked today is the electric mobility industry. So, in your opinion, I mean, should investors be betting big on electric mobility stocks, or these are the early days and one should wait for some more evolution to happen before they put money in this kind of
Certainly,
stock?
certainly, Vijay. See, as a team, we are not in favor of any
Mm-hmm.
thematic investing, going betting big on any particular sector or theme,
Mm-hmm.
uh, because we believe that themes oftentimes, if there is any merit, they are more than priced in, into, and there's great risk. Let me give you some examples. So infrastructure was a big theme in the 2003 to 2008 time frame, right?
Right.
A lot of infrastructure funds were launched, but ultimately, was much money made out of that.
Mm-hmm.
Dot-com was a big theme before that. Real estate was a big theme in 2008 as well. And at that time, when you were in the midst of the theme, the opportunities for real estate companies seemed at least as enormous, if not more. If there is something more than infinite, I would say, just like electric mobility, the opportunities seem close to infinite right now. Similarly, in real estate in India, 2007-8, it seemed like 1.4 billion people, very few having houses. Even those who have houses want more bigger houses and all that. It was almost as close to, you can get to infinite possibilities and opportunities, right? And see what happened to real estate index, went down 98, 99% or some such number after that. So just thematic betting is prone to disasters oftentimes. Having said that, you don't ignore any area of the market just because it is a theme that is in favor, nor do you whole hog embrace it. You have to look company by company whether it makes sense. Sometimes, even in a great, fast growing segment, there may be, from a bottom up perspective, nothing worth investing in. Because just growth in itself does not deliver returns. Look at wireless carriers. Wireless companies, what returns have they delivered over time as an industry, or even individually, if you see? 95, 96, 98, whatever time frame when wireless mobility started, one would, if you were told at that time, less than 1%, I mean, till early 90s, less than 1%, or about 1% of the people had phone. Forget about wireless, fixed line, 1% penetration, zero mobile. And if you were told that 70, 80, 90% of the people would have wireless phone, you would think that these wireless companies would just mint it and you would make so much returns from that, right?
That's
And look at the disaster from an investor perspective, with several companies going under and others almost going under, right?
They
As an
just,
industry, they
yeah.
didn't deliver. So just because a industry is going to grow wild, like wildfire, doesn't mean investors are going to make money. And
Mhm.
that's something that investors repeatedly forget. You have to be extremely selective. You don't ignore, but at the same time, you just jump whole hog into something just because it's growing fast. It's like jumping into wildfire from an investment perspective.
Sure, sure, Prashant. So, let me raise another very, very connected question. So, do investors go for stock picking or sector picking in the current market scenario? I'm just borrowing, words from the previous answer, the reply
Absolutely.
which you made. You did not favor theme so much, but what's your view on stock picking or the sector picking in the current market scenario?
Yeah, I think not just current market scenario, Vishal. Our view is in any market scenario, always at every point of time, the way to invest, because the way to make money is
Mm-hmm.
through investing in individual companies, identifying great companies at attractive valuations and various other attributes that are relevant, and then selectively investing them. Uh, One example, let's say ICICI Bank has been a great success story over the last 25 years, right? Now, about 25 years ago, there were several licenses given for banking. Banking is great sector, no doubt. But if you had just arbitrarily invested, you could have been stuck with lemons. There were several banks. You and I might, remember. Many of the viewers might remember that they are no longer around today. They had to be bailed out because they were not. They were suffering huge losses, right? But a select few banks created lakhs of crores of value. So the
Yes.
value as an investor is created through select businesses rather than betting on sectors. And that is true at all times, including right now. And same can be said for any sector. IT services. There's so many IT services in the 90s. Some of those companies that are no longer around might have been bigger than companies that are now multi-billion dollar companies, right? Some of the companies in the early 90s might not be much different in size from Infosys in late 80s, early 90s, and so on. But those are probably not, some of them are not around today. Whereas Infosys, TCS, and all, or HCL Tech, Wipro, they've grown by leaps and bounds. So selectivity, individual stock selection is what delivers returns. Sector, themes, all these are more akin to gambling. Investing in individual stock through stock selection is more investing.
That's very well said, Prashant. So your vote would be the bottom up approach rather than top down.
Always.
That's what I heard you saying, and I agree. Be it a banking or be it telecommunication. We see many had ventured into this space, but very few could survive. Handful of companies which we can count today actually.
And in NBFCs, you see how many companies in early 90s there were so many hire and leasing and hiring company, lease and hire, right?
That's
Leasing
right.
finance companies. How many of them are around today?
Yeah, hardly. It's difficult to even recall a
Yeah,
few names also. So before I end this conversation, let me come to one question and very straightforward. Your top 5 investment ideas for our customers at this point of time.
certainly. I would say, ideas, or I would put it this way, in a different twist to what you're asking. I don't know whether you meant ideas in terms of stocks or sectors or what. I would give more generic, given the very uncertain, volatile time periods, and in view of what questions I get most. I would say, first and foremost, approach it as an investment rather than speculation or gambling. So if with that in mind, I were to share some thoughts, I would say first, uh, formulate a robust asset allocation plan with financial
Correct.
advisors, let's say like ICICI Direct or any of your peers, a solid sit down, spend time in depending on your specific conditions, and situations and circumstances, put in place a thoughtful asset allocation plan. Second, I'm biased towards equities. I believe equities over the last century or 50 years or whatever time period, while there is uncertainty, it has delivered, and in my view, can deliver well ahead of inflation. One of the few asset classes that beats inflation very regularly over extended periods of time. So it's one of the highest returning asset classes, if not, I would say the highest returning asset class. Fixed income, obviously there is a certain safety, but in real terms, you end up losing money in fixed income over extended periods of time after taxes and all. Assuming that when you say fixed income, you're talking about low risk fixed income. So equity is in my biased opinion, the best asset class. Third, I would say trying to time market is completely impossible. Many people say it is very difficult to time the market. They are misframing it. They are trivializing it, I would say. Difficult is something which can be done, but is difficult. Market timing is impossible, and recognition of that, I think, to me personally, early in my investing life, recognition that market timing is impossible has been a big boom, and that has helped generate stronger returns over time by not trying to time the market. Then what we were just discussing, this macro investing like sectoral, thematic and all are more similar to market timing only, because market timing is a way of macro investing, and all these forms of sector rotations and thematics and all are more macro and do not generate any value, but are more introduce risk in the business. A true way to generate value over time and stronger returns over time is through investment, through stock selection. That is basically investing in businesses, which is where you're owning a portion of the business. So for a small amount of money, you can own a fraction of Infosys, as an example. Otherwise, with, let's say, 10 lakhs of rupees, as an example, you won't be able to start a small company like Infosys with that level of, you can't start a company that is a small fraction of Infosys with 10 lakhs of rupees and be as profitable as Infosys is. But equity market allows you the opportunity to, with just 10 lakhs of rupees, you have a fraction of Infosys with the profitability of Infosys and so on and so forth. Otherwise, if you start 10 lakhs, say IT services company, it will be loss making possibly. Right? So you have to approach it that way. And that is what we mean by bottom up stock selection. That is the true way of making investing. And it is an investment where value can be created over time. And in speculation is a zero sum game.
Yeah, and let me add a couple of points, in terms of investment principles or the best practices. And again, from my own experience, and also when we look at the data, I mean, the analytics, because we have a huge customer base, we have seen people making money. We also have seen people losing money in the market. So I think one first and the foremost thing which I would say, retail customers, I mean, we all have learned to digest losses. I mean, we buy at 100 and we keep on investing, averaging, etc., till it goes to 30 levels, 20 levels. But on the other hand, we have very little stomach, to digest the profit. I mean, I often see investors coming out of very, very good stock, very good picks, often at 5% profit and 10% profit. So I think when this market is capable of delivering, and outperforming any other asset class, then one has to learn and develop that ability to hold on to good stocks. I mean, I remember 2008, 2009 times when times were bad, but many good companies were available at throwaway price. And I personally, I invested at that point of time, and I continue to hold many of those stocks today. So, I mean, few of them have gone up by 5 times, 7 times, 10 times. But that is not something which, should be the decision-making criteria to exit? I mean, as long as stock is performing, you really have to stay put, give enough opportunity to your investment to deliver returns, and exit only when there is a reason, right? So, I mean, I hope you agree with
I
this.
see past, and there are PhDs from MIT, Harvard, Stanford, and all these places who
Yeah,
for donkeys years have been trying to figure out a way to predict future returns based on past prices. And
yeah,
they have been able to figure it out, right? So where the stock has come from should not drive your decision to
absolutely.
entering or exiting. So just because the stock has gone down should not be the reason. Simply the stock price going down should not be the reason to buy or sell. And simply the stock price going up, to your point, Vishal, just because the stock's gone up should not be the reason to sell or double up on it, right? At any point, the decision has to be
Merit.
based on fundamental merits at that point in time, and in context of that, what is the valuation? So I agree with you, Vishal.
Yeah, yeah. Thanks, Prashant. I mean, it was very, very insightful talking to you. Again, time is a limitation, so I am kind of, mindful of the time for your time as well as viewers' time. And it
Thank
was really my privilege to host you today on this show. And I'm sure that our customers, our viewers will also be hugely benefited by this short conversation.
It's my
And
pleasure and really enjoyed our conversation. Thank you for having me here.
yeah, and hope to see you again sometime on the same platform in the future.
Certainly. Hope to see you again soon, Vishal.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.